the chart on the left hand side, that is the 5-minute chart. It's set to regular trading hours, so that way I can adjust where we get our first opening price. I'll just drag this up here down to it, and this is a 15-second chart, and this black line in here is just the previous settlement price. So here is our opening range gap high. First 30 minutes we're looking for half the gap to fill, and here it is essentially done so, and the gap is real close to being filled already. And it's also inside of the new day opening gap, so it's a little lackluster in terms of what you might expect for big volatility. So it's really next to a little unchanged in my opinion. Remember I was teaching you about how big the opening range gap is and what information you get from that. There isn't a large opening range gap today. It was a premium gap, so now we're below it. So you want to turn your attention to, and you can notice the difference between where we opened out here on the regular trading hours. That was the point of showing that. Now we're below it, so you want to see, do we have any respect inside this area here? It's also the consequent encroachment of the new day opening gap for today, so September 12th new day opening gap. Now there's a little bit of a buy side imbalance, sell side inefficiency on the hourly chart. Let's see where we're at in here. So that is something that might be a catalyst for us to then try to seek more of a premium or try to explore the upper end of that opening range gap. And we'll put our quadrants on that. I like the fact that we opened and trade lower because that's punishing those individuals that want to chase the rally that was yesterday. Very classic market making. So you can see we did trade in the upper quadrant of that 5-minute chart over here. So now we have a minor buy side here at the end dog for today at the low, the previous settlement price here, and then we have the opening range gap itself here. So we want to see if we can dig up into that. We have minor buy side sitting right up here at these highs. See how we worked from dropping lower into that 5-minute buy side and balance sell side inefficiency, which upsets this liquidity right here. Now there's that minor buy side swept there. The lower run into this buy side and balance sell side inefficiency. If it's bullish, when there's an inefficiency, we are not looking for a complete overlap of that single candlestick that makes the inefficiency. We want to see sensitivity in the upper half of it. You can see that actually happening here. And then digging up into open, trading down to the top of that opening range gap, the high of it, and then rallying. I'll turn our attention to exploring a little bit higher up. You see how we just dropped down into the high of that opening range gap again? There's a small inefficiency in there as well. So allow it to get into that and see what it wants to do with that information. So for a model, you can use the one that was outlined over here, narrative I shared on this morning. I want to see it drop down. It dropped down into a discount array, which is this buy side and balance sell side inefficiency. You frame it with this candle's low, this candle's high. Upper half of that is where the sensitivity is going to be. It means if it's going to be bullish, that's where you want to find the setup, or it trades down into it here. Then aim for the opening range gap high. That would be a very low hanging fruit objective if you were trying to use this as an area to go long for that. The minor buy side liquidity was the next one. So far we have dropped initially right from the opening bell. Opening price is here. Just doing some work inside the opening range gap. So we have a very large smooth area that we watched a week ago, 19,695 if you look at it on a 60-minute chart. So if we look at how all these highs over here, see how clean they are? I'd like to see it drop down and then start working towards that level. Does it need to go there entirely today? No, but I'd like to see it try to march towards that now, because it's done a tremendous job of destroying any short sellers yesterday by just going higher and higher, pressing into that. So that's kind of like what we're looking at for the remainder of the year. I think we're going to have a very busy fall going into the end of the year. So volatility is going to be off the charts. Like, it's going to be very fun, but very dangerous. So don't think that every bet should be heavy. You should be more inclined to lower your leverage, but your trade frequency can, if you're going to be working these lower time frames, that can actually be elevated a little bit more, because you're going to have a whole lot more setups if you know what you're looking for. Right? So that's the smooth area I like longer term. That's what we're looking for. I'm going to drop back into a 1-minute chart. It's playing a little dirty this morning, back and forth in there, tagging that new day opening gap and previous settlement price multiple times inside that area. And your 933, 930, 931, 32, 33 candlestick, the opening range essentially is that first presentation fair value gap as well. That would be your first fair value gap between 9:30 and 10 o'clock. Give it a little bit of time. It's working around inside that daily range from the highs here down to that low, back into opening range gap. Opening range is the time, again, between 9:30 and 10. Okay, so it's the first 30 minutes of trading, and what you're looking for is initial buy side and sell side be established. You're also looking for any initial PD array, so any significant break or any significant imbalance, buy side imbalance, sell side inefficiency, sell side imbalance, buy side inefficiency, busy, sissy, it's either or, and that'll give you the context for perhaps a silver bullet trade in 10 o'clock Now look at the 1 minute chart over here. It's a little gnarly, isn't it? Now contrast that with days where it just has a really nice gap. It has very obvious buy side and sell side that has a range away from where it opens up at 9:30, and those buy side or sell side liquidity pool. And there's a larger gap opening. You don't want to be having a whole lot of excitement around days that have a very small opening range gap like we have here. It's literally like 15 handles or so. So it's not even very much between the previous settlement price and the opening price, which is the higher price between yesterday's settlement price and today's open. So that's what makes it the opening range gap high. And by definition, that would be the opening range gap low. So one of the things that we watch pre-market, that means anything before 9:30 opening bell, is we're looking for, is it maintaining its opening range gap? Or as we get closer to 9:30, is it reducing it in size? Because if it's reducing it in size, that means we're going to probably have a very muddy morning, or at least the first 30 minutes could become potentially a very muddy session. And so far we have all of this choppiness in here. And while I would prefer seeing it go higher, there isn't anything in here to operate on. So we have to wait and let the market do what it wants to do. Keeping in mind that everybody on the street has saw that move yesterday, and they want to be long. So that initial drop down may not be all there is for a Judas swing. So this drop down here, they may want to go one more time deeper than that. And anyone that's already long, they could be displaced from having that position and no longer be in the market. So it takes a little bit of patience working with these types of environments. And no one really should be looking at this and thinking, wow, I gotta get in on this. It's gotta be, the market's not really poised yet to do it. So just give it its chance to move around and finalize all of its opening range. 15 minutes is not enough information for the daily range. Between 9:30 a.m. to 10 a.m. That is the algorithm's opening range. It sets up initial buy side and sell side and then operates with that. You can also do standard deviations on this range. Hello, hint, hint, nudge, nudge. So it gives you all of these projections. Yes, Virginia, if you take the highest high and the lowest low in the first 30 minutes and project them up, you're going to get your intermediate term and long-term daily intra-session highs and lows. All right, so here we are back inside the opening range gap. Now, I like the idea of what it's doing in here because it's falling short of going any higher above that 290 level, and we're back inside the opening range gap. We have relative equal lows in here, and again, this is a 15-second chart, so there's liquidity resting below into that, and I like to see it one more time go below these lows over here, because again, I was saying earlier that everybody on the street, that means people that just watch the news, they watch CNBC, they read newspapers or articles, or they watch other people do something, and then because they did something previous day that was bullish or bearish, and it was a big day, and there's a lot of excitement about yesterday, they'll want to go in, and their bias will be, well, I want to do what was happening yesterday, because large ranges, it brings in a lot of excitement. And you can see how the individuals that maybe would look to go long, or maybe that are long, naturally their stop loss is going to be right here below these lows in here. And it takes a little bit of time watching price and presenting these a little bit harder conditions where if you're just really impulsive and you want to take some action getting in because you think it's going to keep going up for a longer time. The first 30 minutes of the next trading day, if you sit still and don't do anything during that period, I promise you there's lots of other opportunities. You don't have to trade the morning session either. Like you can literally just trade the afternoon session. So my question to you is how many of you already remembered that you're not supposed to be doing anything in the morning session today? That's a large range candle yesterday, right? On your daily chart. So the protocol is what? You don't trade in the morning session. If you're brand new, you don't trade the morning session. We just banged the lower end of that new day opening gap. So we hit that. I'd like to see if we had any interest to explore lower low, not for the sake of expanding lower, but just to go down into maybe consequent encouragement of that 1 hour buy side and balance sell side efficiency. And there we go. Large range days, you got to be careful in the morning session because they're going to punish anyone that wants to be on that same side of whatever the previous day's range was. If it's large on your daily chart, when that occurs, next morning session, sit still. Write it down in your journal. You have permission to sit still. You have permission not to trade the morning session. Remind yourself that. I promise you will probably save yourself a whole lot more frustration and equity and not probably blow your account or go on tilt because you're forcing something in an environment that's already predisposed to try to hurt individuals, doing the very thing that yesterday's daily candlestick showed. In other words, extremely bullishness. Okay, well, they're going to lay down a landmine field in the morning session because what that does, let's make the argument for the sake of if it's going to go higher, and it can, I'd like to see it go up there and take out that 19,695 level. I would like to see that disrupted, but it doesn't have to do that. It could do that months from now. It could do it years from now, okay? Or never, right? Those are always possible scenarios. But because yesterday we had such a huge, very, very energetic, entertaining candle on the daily chart that just kept going higher and higher and higher, that excitement bleeds into the next trading day. And now everybody's out here that are novice traders, they're excited. They want to be long. So they're going to take buys on everything that they can hear someone talk about, follow signals, if someone says something on online chats, that's going to be the catalyst to say, yep, that's all I needed, that little bit of a bump. And now I'm going to take initiative and get in there and trade long. And in the first 30 minutes of the session, what generally happens is it allows these types of traders to come in and it lays down a little bit of breadcrumbs like, hey, look, we're going up, and all of these little bull flags in here on the 15-second chart. And I liked how like I said, it was failing to get up there. It means it's likely to do what? Roll over and dig into that buy side imbalance on the hourly chart, which is the shaded area is blue, and then take out that initial low of the day where there's sell side. So why would that be advantageous for the algorithm to do that? Why would it be a good thing to see something like that unfold? Well, because you actually have early buyers coming in trying to do what they saw yesterday's winning crowd do, be profitable being long. So if they lay down this landmine field of here's a low, start sending a higher, opportunities to go in here, supply and demand guys, okay, they'll call this a demand zone, and they give it to them here, and then no, we're not going to let you go higher. And even the supply and demand dudes are going to be doing what? They're going to place their stop loss below there. Fibonacci traders are going to be buying down in here on retracements and ratios. And harmonic pattern traders are going to get all this little bit of a movement lower here, and they're going to get excited by that, and they're going to buy it. Moving average crossovers. Okay, every possible indicator that is an overbought, oversold momentum indicator, they're all oversold here. And then what? Everybody initially that's long on a large range day that closed higher in the first 30 minutes, that low is always going to be a suspect low. Whatever low they form and they paint this little tiny short-term low, always expect that scenario that they're going to lay that down as a trap. You can use it as a turtle soup. You can use it as a scalp to trade down into that over here, working the upper end of that opening range gap in here, breaks lower, trades inside of this inefficiency, and returns right back into the end of, and then trades lower, and it sweeps the low over here where the sell side is. Now it's accumulating inside the end dog, and I like to see them run up in here and clear up some of this buy side. And how we trade there once we get there will be indicative of any continuation going forward. But we're still inside that 30-minute time frame, so you have to be careful. You don't want to be trying to bet the farm yet. You're not trying to secure the low of the day or the high of the day. They can play real dirty in this first 30 minutes. So we're still inside that opening range gap, end dog low. So what you're learning, Caleb, is things to lean on for logic, comparing what the daily range was and how price traded the previous day and or the last session of the day, the PM session and the last hour trading. We are inside of over here. Watch this. This candlestick's wick, midpoint, consequent encroachment. We came down, hit that. So I'm watching this level here as I'm watching the 15-second. What makes the markets go up? Buyers seeking what? Higher prices, and that buyer has to buy at a discount price, and that's what the algorithm affords it. Okay, so we've completed our 10 a.m. opening range, and now we're inside of the opening range gap, the low of it, touching the end dog low right there. So now look at that 1 minute chart. Nothing in here is terribly exciting, is it? We're basically unchanged from where we closed yesterday. So how's that exciting? It's not. And this is typical of what you see on a morning session after a large range day. We have minor buy side here. So we had sell side below this low here taken. Look at the bodies down here. What were the bodies respecting? The lower quadrant of that 1 hour buy side imbalance, sell side inefficiency. So touch the end dog high again here, and consequent encroachment of the opening range gap. I want to see if it can mount a run into the liquidity resting above the 288.75 level. Better trading should be in the afternoon starting 1:30 p.m. because we had a very anemic opening. It was really small in terms of opening range gap. It's after what? A large range up day. At 1:30, sit at your desk and then trade the afternoon session because you're going to get a whole lot more cleaner price runs. You won't get a lot of this fickle back and forth. I would want to see it run here to that 288.75 level. If it's bullish, it should run here. But keep in mind, Caleb, while you're watching this, you're in a session post large range. So what does that mean? Setups are more prone to fail. That's the reason why you should not be trying to go in here and press it hard on a morning session after a large range day. That is a climate and a characteristic about the daily range that you have to at least be aware of. Wait for the opportunity with the characteristics of the daily range to be there. All right, we're back down into the end dog. So now imagine for a moment, okay, say for instance that you were wanting to trade today, okay, and the very first fair value gap that forms on the 1 minute chart is you have it at the 933 candle. So trading down into that, we get a delivery above the short-term high here, yes, by going here. But what happened after that? Right back into the range, and then attacked what I was outlining, that they would use the initial low of the day to target anyone that wants to chase the price that was delivered to the market yesterday, which is a very large up close day on the daily chart. So the market came down, took those individuals out. The bodies over here respected the buy side and balance, sell side efficiency of the hourly chart, that blue shaded area here. And then they ran just for short-term liquidity there. And this big balanced area here is offering initial high resistance. So you have to sit still and take in more information. You're not trying to press the button on these sessions. You're not trying to be smart. You're not trying to be right. What you're doing is you're seeing how are they hurting traders that just can't sit still? How are they doing that? They keep causing retracements to take out short-term lows, but they're not letting the market go higher. Look at the 15-second chart. We have this low here, which is the upper quadrant of this blue shaded area, which is a 1 hour buy side of balance, sell side efficiency. The market trades down below that and then trades higher. It creates a swing low right there. You see that? That swing low, what makes it interesting is that that swing low is forming at the high of the buy side of balance, sell side efficiency. So that upper quadrant level is where this swing low is forming. That's going to have liquidity below it that has an interest. In my mind, I'm interested in seeing that. So when I'm watching price deliver, is it doing a run below that? It does. And then you have this swing high, which happens to be just at the top of the opening range gap. That's this gray shaded area. There's what's above that. It's buy side. So the market does what? It sweeps the sell side here, attacks the buy side here, and then the relative equal highs, it's taken that. And then we have a swing high here at the high end of the opening range gap again, and there's sell side below here. So we're digging into that. Every single time it takes the sell side, it's not coming up deep enough to get into that 19,288.75 level. So to me, when I see this, let's say for instance that we stay in the range between the low of this buy side and balance, sell side efficiency on this hourly chart. Say we don't take that out, but we maintain the highest high that's formed today, and we maintain that range throughout all the morning session and going into the lunch hour. If I turn my charts on at, say, for instance, 1 o'clock, 1:15, right before 1:30, and that range still is there, then I'd be more inclined to expect to see them to release it and start exploring higher prices. Right now, they're just chopping people up because they all want to be on board. And every time short-term lows are being taken out, what's below that? Sell side. Why would that be gainful? What would be the advantages of seeing that unfold? Someone's accumulating that. Someone's accumulating those stops that are being taken out. There's always somebody buying and selling. But my interest is, where can that buying and selling be targeted? It's where are those orders and where are they laid in a manner where the narrative can exploit that. So for instance, let's say that you are bearish. Your eyesight should be keened on every short-term swing high, every time frame. And you would be watching and monitoring how price is delivered once it trades above those short-term highs. And if you are on side and you have the right analysis that you think the market is going lower, the market should accumulate those short-term highs for the purpose of taking the buy stops out. And then your mind should think, okay, if that's occurring, that means smart money is probably in the move, right? And they're building their position. Every time these short-term highs are taken, they're establishing the other side of those buy stops, and they're leaving their orders in because they expect what? A longer-term move lower. Well, here we're seeing the exact opposite. We're seeing all the short-term lows here being swept there, these here being swept there, and that one making sure that one's gone. The buy side that's resting here and the high of the morning session over here, where these clean highs are, that's where the next buy side would be. So we would have to measure what the delivery of price is once it gets above these levels here, because it's already done enough, in my opinion, to accumulate enough of the sell stops to then now allow for that daily range to try to flirt with a little bit of a, think about it. If they want to send price higher, they have to do what? They have to enter before it goes up. So what's the easiest way to find sellers at a cheap price? Take out short-term lows. And those short-term lows being taken out, that means that their sell stops, the sell stops being taken out affords the smart money to accumulate them. And see, retail is going to buy and sell, and be impulsive about what they're doing. Where smart money sits still and they wait. The initial 30 minutes or so of trading, there's this big rush to do something. They pounce on them to eat them. And that's what smart money's doing. It's waiting for these opportunities for the market participants to say, okay, I want to be on board in the marketplace long. But as soon as the bell rings, they're going to go in there and buy. Or they'll wait for some kind of a initial support level. And when they see this type of movement here and it starts to rally up, highs are being taken there. That's a breakout. They're seeing what pattern here? Bull flags. Oh, there's some support in here. And then it rolls over and goes where I told you to aim for, which is this low. And it went down below. After hitting the end dog, it's going to go down here, from here rather, take out that initial low of the day. Why does it want to do that? Because it's engineering sentiment for traders to be discouraged. So don't think for a second that it just has to be below no low. If the market starts to show like this feint of a move, like it wants to go lower, I told you it was just going to go down and take out that sell stops on the initial low. And then it cleared the relative equal highs over here. And look where it's pressing in here. As a short-term intraday trader, you're looking for something to provide a catalyst. Okay, if you're bullish, what gives you the framework to trust that the market itself should go higher? Don't tell me the patterns that you're looking for. That's the least important thing, because that's your entry. The entry is not important. Why should the market go when you think it's going to go up? That's the more important question. And if you go in right out of the gate at 9:30 in the morning after a large range day, you're going to be met with adversities and you're probably going to get stopped out. Even if you're right on the direction of where the market's going to likely go, or the short term, the intermediate term, or the long term draw on liquidity. If you're bullish, that means like where you think it's going to go to as a target. You may have all that right, but if you don't expect adversity, range bound time distortion, that's what you're experiencing in the first 30 minutes after a large range day, whether it's a bullish day or a bearish day. When you see a large range day, the next morning session, expect that first 30 minutes to just mark time. They call it bar coding. To me, it looks like a picket fence. Just goes sideways. That's what you're seeing essentially in price action in that first few minutes of trading. And then you wait for a minute to move. 19,695 level it's ripe for the picking, basically. Now we have some range to get through to get to that level. That's what I was thinking about in terms of the narrative today. See, I like how it's been keeping the ability to not go above that 288.75 level. And then I think it's going to roll over and you can take out that initial low of the day. At the bottom end of that NDOG new day opening gap, at the time, I said we're hitting that. We're going to see if it wants to roll over and take out that initial low. It does so. Towards what level? It's the lower quadrant of that 1 hour buy side and balance, sell side inefficiency. So if it's bullish, what you want to see is you want to see them not completely fill. You don't want to see them fill. It can trade all the way down to that low, but that's not what I'm looking for. And that's what I'm teaching you to look for. The opening, staying some portion open. You want to grade that inefficiency that's defined like this, between this candle's low and this candle's high. And if you drop your fib on that and you put it in 25%, 50%, and 75% of that range, you can see what the algorithm will do, because it's doing this very thing here. The mechanism that it's calculating on is they're taking this high, this low, and they're getting this level, and this level. If it wants to go higher, it will not go down here and touch this one. That's what smart money's looking for. It's looking for this lower quadrant or halfway point. Ideally, you want to see it in the upper half. But if it's going to go below it, then it becomes essential for it to be respecting the lower quadrant and still leave that lower boundary point intact, not trade to it. That's what they want to see. The liquidity here was taken. So this is your Judas swing. It's a deferred market delivery. Whereas initially you have this, it drops down and gives you a short-term low, and then it rallies and they take out a short-term swing high, because what will traders think that do happen to be on side, they'll see that as a breakout. When they have that confirmation, anyone and everyone that may take longs in this market, they're going to start looking for where their stop loss would be. And their only logical place at this point here when there's a breakout is it's this low. That low is your initial low on a day that is predisposed to go higher. So they're going to give them a trap. When it gets below this low here, this is your hunting zone, right? So that's sell side. There, that's retail. Smart money waits for the algorithm, because it's two different things there. The algorithm is the price engine that drops price down there. That lets smart money accumulate their long positions at a time and place. Now, what's the missing pieces? Price. What price? Well, you have this buy side balance, sell side inefficiency. We grade that. Lower quadrant, consequent encroachment, upper quadrant, and the high. Where does this low form? Just above consequent encroachment. So if you are a trader that wants to scale in, you want to see it trade down into consequent encroachment, you can scale in and do one contract there. And if it gets down to the lower quadrant, you want to do one contract there. And then your stop needs to be at least 2 to 3 ticks below the buy side and balance, sell side inefficiency, because it can touch the low. We don't want to happen. But you have to afford yourself the potential seeing that deliver all the way down to that candlestick's high down here on the hourly chart. Okay, so the price levels you're looking for is the lower quadrant and consequent encroachment. And then any inefficiency between those two price points. Watch. PhD level. Oh my goodness, man, this is amazing. I know. I actually have old floor traders, and I have quote unquote institutional guys in the comment section telling me this is mind-blowing. Yes, of course it is. It's ICT talking about it. What are you talking about? Why are you surprised? So we have this price level here and this price level here. So when price trades into it there, that is a what? As a potential entry. Now, would it be wise for you, just because it trades down there on a down candle, would that be wise to trade that? No. Just simply because it's cheap and it's at the price level, is that a good time to be a buyer? No. Because we have to be a buyer after it shows us it's given enough information. We're not looking for confirmation per se. We're just looking for a little bit more, because this thing could still drop all the way down to the low of that buy sign and balance, sell sign efficiency, which is on the hourly chart over here. Okay. So what we could look for is price trading down to consequent encroachment. And we know that it could potentially trade down to the lower quadrant too. So you could do one contract here just to make sure you got something on. Now, if you're in a certain particular prop firm, you see this price, you wait for it to trade to it, and then watch how it behaves. It trades to it, returns back up into old low, this portion of this SIBI, which is this candlestick's low to this candlestick's high. The most sensitive price points are going to be in the lower half of it. These are all the things that you're supposed to be doing every night. You want to look at all these price runs and see, this is a signature. Does it get up there to the midpoint? No. So what does that mean? It's weak. So it's going to go to the next level. What level? This level down here, the lower quadrant of the buy sign, balance, sell sign efficiency. So when we're seeing that, we wait for it to drop down. Then this candle, we open up, trade right to this candlestick's low. What is that? That's an immediate rebalance. Every single one of you should be screenshot. I'll move out of the way. Screenshot this candlestick's high right here. I'll move my cursor out of the way in a second, but what you're going to do is you're going to load a line on here and draw that out in time, or you can draw it this way and annotate that as a immediate rebalance, and the market drops aggressively. Go ahead and take a shot of that right there. And then also this discount wick. So you have immediate rebalance plus consequent encroachment. And it's also trading where? Near consequent encroachment of the buy sign and balance, sell sign efficiency. So that's not one thing. That's not two things. That's three things. And the price goes down and hits the lower quadrant and trades just a little bit past it. If we don't want to see that lower quadrant traded to, so this candlestick right here hits the lower quadrant. Let it sweep this level, that lower quadrant of the buy sign and balance, sell sign efficiency over here. It does that here. And then we see what? The market trade higher. As soon as this candlestick right there, that opening price plus the volume imbalance that's there. See that? There's two PD arrays, two of them, after it's hit the lowest level that we want to see trade to. And it's already worked below it a little bit. Now we have the market trade higher right there. That makes that candlestick right there and these series of candlesticks. Here's some order block theory. This opening price, and then you have this one. This is a change in the state of delivery right there, because we've already hit the lowest level that we want to see traded to in that buy sign, balance, sell sign efficiency. It went below it, traded higher, and then what happens the very next candle? We open up here. So there's a separation between this candlestick's close and this candlestick's open. See that? So this makes this what? At the time of this opening, that makes this a vacuum block where there's no price at all between these two candlesticks touching except for this wick. It trades down to this candlestick's close. That is an immediate rebalance because the wick is a gap. So we trade down immediately there, and then price starts to deliver all the way up to the first of all these down close candles. This is the high of your entire order block. Market opens up here, trades down into the order block here, and then starts setting price higher, reaching up, creates a swing high towards the high end of that opening range gap. Sell side taken off that low. Low takes out that low. They are accumulating what? Sell side to send it where? Higher. If you're looking on a day there wasn't a very large range day, like say for instance yesterday, we didn't have this monster of a daily candlestick. Say it was just within the realm of an average daily range, maybe just a little bit above it. You could be trading the morning session and you would not have to incur all the hardships that the initial 30 minutes of trading can afford you like it did today. And also, you're more inclined to see a more protracted run in price. That means where we took out the short-term high here. This high on the 1 minute chart is this line here on the 15-second chart. So we had high, slightly lower high, so relative equal highs. They rallied it and then sank. All this type of price action, they're all characteristic of a trading session in the morning after a large range day. So my question to you is this. Do you want to trade when the market has these things that you have to worry about when your experience levels a lot lower because you're just now starting to learn about it? Or do you see the advantages of seeing these characteristics? I'm going to show you conditions in a good low resistance market condition, and I'm going to show you characteristics and price delivery in high resistance conditions. So that means you're going to see what it looks like on both sides of the spectrum. Now, the advantages are when price is in a condition or characteristic that's defined by in the morning session after a large range day, you have to be extremely careful not to get all caught up and think that you have everything figured out. Not in the beginning. Again, the beginning, you're not gonna know what you think you should know, and you're gonna discover that you don't know what you should have known because your experience level is just not there yet. But do you think it's helpful to you to know when you're probably gonna lose money easily? What's gonna make your trade harder to pan out? So you want to know what it looks like to trade in low resistance liquidity run. Okay, yeah, I want to teach it to you, and I have been. But the easiest way to determine what that is by showing you what it looks like when it's harder. So the point is this: by learning the difficult pathways to where you're trying to get, you'll also know that there are certain pathways that are actually a lot more smoother. But the only way you can appreciate that way of doing it is by walking through the bramble bush, because trading is going to present those characteristics to you. There's going to be periods where your trading is going to be like that. But there are specific and generic trading times where the market will present these unfortunate characteristics where you just can't go in one entry and keep pyramiding and it's never going to retrace on you and just keeps running in your favor. You're going to be in like quicksand initially, where it's like it's hard to feel what it's doing. How can I know that I'm doing the right thing by sitting on my hands? The richest traders are the ones that have planned stillness. That means they're not trying to trade. They want to be in the markets when its highest degree of probability is in their favor, not in the market's favor. You want to go in a condition where you have the highest probability of having your ass torn off, or that you have done your due diligence and you have waited to a proper time when there is no large range day the previous day that would negate you trading in the morning session because your experience level is not there. But you have to appreciate when the markets are a little bit harder, when they're being held at bay, where they are not allowed to just run around and do whatever they want to do. As soon as you can recognize that condition in the marketplace, the better. And as soon as you recognize it, turn your charts off and walk away and come back the next session. And since it's the morning session here today, the easiest thing would be to turn off your charts, let it do whatever it wants to do all through until 1:30 in the afternoon later today. And then sit down, determine where the highest high and the lowest low of the day is. Look at the morning session high, the low of the day in the morning session. And then what was the highs that was formed in between those two reference points? The next lower highest and the next higher low inside that range that defines the highest high and the lowest low at 1:30. There's two buy sides that you'll have and there's two sell sides that you'll have. Chances are it's not going to take out both of the highest high and the lowest low again going into the PM session, but it will gravitate to one of them. The question is which one do you think, without even being at 1:30 yet, which one is it most likely going to do? I want you to write that down in your journal and put the time that you wrote down. And then at 1:30, watch and see what price does. Discover where the two buy side liquidities are and the two sell side liquidities are. You have your lunch high, your lunch low, and you have the high of the day and the low of the day. That's what you walk into the afternoon session doing. It's the same thing that you would do in the London session. You're just going to use the previous trading session the same way. The previous day's high and low, and then the high and the low that's inside that previous day's range that's formed up to 2 o'clock in the morning Eastern time. That's what you're looking for. And then if we don't have a large range day today, tomorrow's morning session will be easy. So you can see how all these things, because you have protocols, you're learning my protocols, and the things and processes that determine when I should do something and when I shouldn't do something. When do I push the pedal to the floor and just go all out? When should I just pump the brakes and slow down? And when should I just turn the ignition off, park it, and go do something else? How often have you thought about that for your trading? You have to learn to acknowledge when the market's saying it's amateur hour right now. So anybody that comes in here is getting slaughtered. Let's take a look at what we have here. Alrighty, so we have 15-minute time frame. I do like the fact that we started the day off going deeper, lower. We took out the minor buy side. We only had a shallow retracement. We didn't come down and take out the low of the day, which is all positive for the afternoon session. So as long as we start working towards any consolidation but not taking out that low, my expectation would be enjoy lunch, just relax, come back to your charts around 1:15, 1:30 p.m. Eastern Standard Time, and then observe where the highest high and the lowest low of the day is on a 15-minute time frame. Then drop down to a 5-minute chart, and then you'll see lower, smaller, short-term highs and lows that are inside the high and the low of the day, or respectively high and low of the day. And it may be a slightly higher high, but whatever that high is at 1:30, you note that, and then you you note the low, and then you use either the lower high that you can see maybe on a 15-minute chart rather, or the 5-minute chart. If you can't see it obviously on a 5-minute chart, you drop down to a 1-minute chart, you'll see the lower high that's less than the highest high of the day or the lowest of the low. So you're going to have 2 layers of buy side and sell side, or you'll watch that form as 1:30's trading unfold going into 2 o'clock. And then at 2 o'clock, what you'll see is the PM session unfold, and it'll start to traverse to either the buy side or the sell side. And I'm inclined to think that they're going to reach for that 19,695 level eventually. Does it need to trade there today? No. So in my mind, I want to see them give me a market structure and opportunities for the market to build that narrative in price. And at 1:30, I'll be looking for that. And if I have something that I like, I will engage it. I will trade it. I will annotate it. I will go through all the motions of doing that. And then you'll see another example. Okay. So I'm literally tipping my hand to you, telling you how to navigate it on problematic sessions, which is after very large range days in the morning session. And then what I use as a protocol. All I want to see is where the liquidity is for the highest high and the lowest low of the day. And then I want to wait and see, does it make a shorter high or a higher low, basically, than the low of the day? And it will go to one of them. And price isn't going to hide where it wants to go. It's going to be obvious what it's going to aim for. And that sets up the framework for the afternoon session. Now, what makes it exciting is in the last hour or so, the opportunity for the market to expand, because that's where it's creating the high and low of the day. And then towards the last 45 minutes, that's when it usually comes off of whatever high or low of the day, and then it goes into settlement. There's 4 macros in that last hour. Technically 5 if you really want to be dogmatic about it. The last hour of the day is them actually pricing in the extreme high or low of the day on big expansion candles, like a day where we open near the low and close at the high. That last hour of trading, that's what's giving you that setup. It's going to reach and make a higher high when it's bullish, or it's going to reach and make a lower low when it's bearish. And in that last 45 minutes, you're basically trying to get a read for how they're going to settle in. Are they going to settle at the high, or are they going to come off that high and come back down into the range? And that's what my focus is. That's what I'm trying to trade with. You don't ever need to trade the morning session, ever. The easier trades always are going to be in the afternoon. The PM trading session is the easiest trading session for index futures. Always, always, always. It's the easiest, absolute easiest, because you have all the daily range already in there. Now, are you going to get the lines portion of the moves? Absolutely not. That's what everybody wants in the beginning. They want the lines portion when you're not going to get the lines portion. But to get in there and get consistent setups that are going to yield to you, that PM session is always right for the picking.